Alrighty, I think we'll get underway. So a huge welcome to everyone who's joining us this evening. Amber and I are super excited to be here. And yeah, just want to kind of run through a little bit about the Kāinga Ora first home loan. So it's one of those things that we get to chat about all the time, but is sort of seems to be a thing that not that many people tend to know about. So we're going to answer any questions. So please, if you do have any questions, just pop them in the chat as they come up. And if it's appropriate to answer at that stage, we'll kind of take questions kind of as per each slide, but also just fire through anything you want to know about home loans or first homes, anything that we don't cover tonight. We're also very, very happy to jump offline and have a chat with you later on. So a very, very warm welcome. So firstly, we'll just do a quick introduction. So I'm actually going to introduce Amber tonight because she is one of my favourite people and I think one of the best mortgage advisors that I know. So she's been with my mortgage since 2018. And is now our absolute policy queen, and also is very fun. She loves to travel. She takes a lot of time off, but we love her for it because her Instagram stories always look amazing. So welcome, Amber, and thank you so much for joining me tonight to have a bit of fun and talk about home loans.
Oh, stop it. It's kind of hard hearing things about yourself.
I know, right?
But yes, I'm going to introduce Claire a little bit. So Claire has been with my mortgage for over 10 years. She has a background in lots of different things, sport, management, retail, but anything revolving people. She is your girl. She loves being in front of people, whether that's our clients, our referrers, or just in our community. She has a major presence in a lot of things in our community. And she loves being on the farm, going back to her roots, and talking to everyone about obviously lending, but also about investments and strategy, being really involved in the property space as well. So that's us.
How exciting. Shall we talk a little bit about our kind of first home stories, just so that people can get a little bit of a sense of like where we're coming from and the kind of experience that we've got. So run through what happened when you bought your first home.
Cool. Yeah, so I bought my first home a few years ago. It was sort of the process started during COVID, and I bought something that needed a title, so it took a little bit of it was a bit of a journey to get there. So that's why I say it's hard to remember. But I bought my first home with my brother. We both had roughly 10% deposit each. So on our own, it was kind of hard to get into the market at the level we wanted to be at. I had a student loan, which at the time impacted what I could borrow. And so we thought, yeah, let's do this together. We were both in a position that made a lot of sense. So we went in with basically equal deposit portions. We also both qualified for the first home grant. So we will kind of touch on this. It's no longer offered, but it is something that was supported by Kāinga Ora at the time, when the first home loan product wasn't really around so much. A couple of years later, I ended up buying him out and I still own the property. It's now an investment, but it was a really great way for us to both get into the market, and he's since gone on to buy something to live in as well.
Yeah, awesome. So my first home was myself and my partner way back in 2014, which makes me seem very old. And we had we scraped together 20% in the end, but it was a much different property market then to what it is now. So definitely a lot of changes over the years, but we also did quite a lot of renovations, and then we ended up purchasing some land, building, and since then have done a few other bits and pieces. So very exciting to always kind of get that energy of buying your first home. So firstly, Amber, do you want to cover off what is Kāinga Ora and how does it fit in with the first home loan?
Yeah, perfect. So Kāinga Ora is sort of formerly Housing New Zealand, and a couple of other government agencies essentially, that have amalgamated together and they do a lot of support in obviously our social housing, providing housing side of things, but they also support first home buyers getting into the property market. They do this mostly through a product called the First Home Loan. So it's like a scheme. It is in conjunction with a number of banks. So there's a few major banks, a couple of slightly smaller banks that all offer this and work alongside Kāinga Ora to offer the product. So essentially, Kāinga Ora is like a guarantor. They provide an insurance to the bank so that they can offer this product to help first home buyers with as low as 5% deposit. So the key thing, I think, we're sort of jumping forward a little bit, but most of the banks, want you to have that 20% deposit, or that's the ideal space they want you to get to. But this product allows you with anywhere from 5 to 19.9% deposit to get in there and make it a little bit easier and more achievable and also cheaper.
Yeah, totally. So that's a bit about the first home loan, and a lot of different people and different websites call it different things. So if you hear first home loan, or you hear the Kāinga Ora scheme, or you hear the Kāinga Ora first home loan, they are all the same thing, but it can get a little bit confusing. So tonight we are going to primarily talk about Kāinga Ora and the first home loan, but we're also going to cover the lower deposit space under standard policy as well, because there are some pretty specific things that create eligibility for the first home loan. So the first thing that we wanted to kind of cover off is when you're getting into your first home and you're starting the journey, what are the kind of key things to consider? So essentially, the first one is deposit. So how much money do you have? Do you have KiwiSaver? Have you got savings? Have you got potentially a gift or a loan from family or parents? There's a whole host of ways that you can source a deposit. The most common ways at the moment are definitely through KiwiSaver, family support, or savings. The second thing that we want to consider when looking to get into your first home, and when we're considering that sort of affordability or the finance side of things, is how much you can afford to borrow, what your income is, and how much money you can essentially afford to borrow from a serviceability perspective. So what that means is basically, what's your income, what are your outgoings, and kind of what's left over at the end of the month. And we call that uncommitted monthly income in our world, but basically it's how much money do you have to service a home loan after all of your financial commitments are taken care of. And that's something that we work through with a lot of people every single day to work out what they can afford and how much lending they can service, and therefore help them set that budget. As Amber mentioned before, the 20% deposit is sort of the gold standard, but it is by no means the only option out there. And probably the key difference is that it does have the best interest rates on offer. So those ones that you see out the front of the banks and on the TV, sometimes advertised and stuff and NZME, those are the best interest rates. They also offer cashbacks, but you do still get cashback with other options as well. And there are a lot of bank options. So every single bank will offer some sort of offering with a 20% deposit or more. And it depends a little bit on the situation as to what bank is the best option. So that's kind of, I suppose, the gold standard. But under 20% deposit, there are still plenty of options. And I think this one is a bit of a myth that's out there in the lending world. Basically, people have been told, hey, if you don't have 20%, you can't get into the market. But that is absolutely not true. There are so many options. So the first one is what we're talking about tonight, the Kāinga Ora First Home Loan, or standard bank options. So every bank has the ability to lend money to people with a lower deposit, so essentially with less than 20%. And those restrictions or those amounts that they can lend are governed by the Reserve Bank. So that is a central bank who helps regulate lending and regulate interest rate and economic flow in New Zealand. And essentially they can make some rules around how banks need to act when they're lending money to protect the overall kind of economic stability of our country. So they have a requirement where they can't lend too much money under that 20% deposit mark, which is kind of where Kāinga Ora First Home Loan comes in and where it becomes really, really helpful for people. So there are some key criteria. Amber's going to cover those off.
Cool. So with the first home loan product, there are some strict criteria. Most of these are a rule, or they're a hard and fast rule. There's not a lot of room for negotiation in some of these, but a lot of people in this space will fit this. So the key part is sort of the income cap. So if you're earning 95,000 or under in the last 12 months as a single borrower without dependents. If there's more than two or more borrowers, we are seeing more than two people kind of jump in. So if there's more than two people, the cap is $150,000, and it's also $150,000 if you've got dependents, whether you're by yourself or with someone else. So with that, it is your income over the last 12 months. So how we get that is we're actually looking at your IRD, your earning summary from the last 12 months, rather than what you're earning right now. So if you've had a pay rise in the last couple of months and you're going, I now earn over that, or jointly you earn over that, there is still a chance you may qualify for this, depending on what that's looked like in the last 12 months. The next one is we're looking at minimal short-term debt. There's not really a number in mind as to what the banks will let you borrow or let you have in this space, but kind of making sure that you are committed to paying your everyday expenses and your commitments, and that any short-term debt you do have, you're kind of managing well, essentially. So if you've got significant personal loans or car loans, we can definitely have a conversation around what that looks like or how that might look in this situation. But most of the time, the banks want to see that your consumer debt is under around $10,000. Student loans don't come into that equation, but this also varies between the banks. So that one, there's not really an amount, so always have a chat about it. The only other one that is probably quite strict is that you've been in your role for the last 12 months. So this means either the same job, or if you haven't been in the same job for 12 months, but you've been in the same industry for 2 years. So say you were a teacher and you changed schools, but you're still a teacher, that would still qualify. So again, it's about that tenure and showing that you've got a commitment to being in that same industry and that your earning potential is stable heading forward. This is all also subject to different banks' criteria. So these are the criteria set by Kāinga Ora for the first home loan to qualify. The banks then have their own criteria around income, debt requirements that you might need. And there are different banks that offer this product. So amongst the main banks, so we've got Westpac, ASB, Kiwibank, SBS, and Co-operative Bank that offer the first home loan product. So that does give you a wide range of options. We do deal with all of these banks. There are some others, obviously, that don't offer this product. They do still have those standard bank options or those different interest rate options. But yeah, these are the ones that will offer this product specifically, and we have to meet their criteria as well.
Oh, so one of the things we did want to cover today is the difference between the Kāinga Ora first home loan and like what we call standard under 20% or less than 20% deposit lending. That doesn't really have a name, but if we talk about less than 20% deposit, that's what we mean. So there's a couple of differences here, and the big one is what we call the LMI, or the lender's mortgage insurance. So that is a one-off fee charged, usually added to your home loan. And essentially that is the insurance that the bank carries out to make sure that if you don't pay your home loan back, they're kind of covered. So they have that fee, which is 1.2% of the overall loan amount. Most banks will offer the special interest rates, which is the advertised rates that you see online. They will offer pre-approvals. So essentially what that means is that if you are wanting to buy a property and you want a formal loan approval, or a commitment from the bank to lend you money via a loan offer, then they will provide that. And the last thing to note is any lending under 20% deposit also needs a registered valuation. So what that essentially is when you are looking to buy a property, we order the valuation, and that means a registered valuer, someone who's studied for many years to become very, very competent with the property market, goes and inspects that property and then compares it to others in the local area in a similar condition and state, price range, and make sure that what you're paying for it is basically what it's worth. Very common that what you pay for it is what it's worth, but the bank just adds that kind of extra layer of protection to make sure that they're not lending more than what the property is worth. So that's the Kāinga Ora side. On the other side, we have what we call standard over 80% or under 20% deposit policy. So in this case, you'll have a low equity margin or an LEM. And what that basically means is that a margin is added to your interest rate, which means that lending costs a little bit more under that standard policy. Less bank funding options basically means that not every lender will provide a pre-approval and not every lender will have capacity to lend under that policy at all times. So what we often see is people who may not have been able to get a pre-approval, but once they do have a property to buy, then a bank is happy to lend them money. Quite often too, the banks will look after their existing customers, or sometimes they'll let us know, hey, look, we're open for approvals, or we're open for people who have got a property to buy, or what we call a live deal. They also require a registered valuation, so that's very similar across both, but the key difference is that lender's mortgage insurance fee versus the low equity margin and the difference in interest rates. So quite often what we're doing here, as Amber mentioned earlier, not every bank offers the Kāinga Ora first home loan. So we're often comparing options across a range of lenders, and quite often they will change what their offerings are, sometimes even weekly. So occasionally they'll offer something special for first home buyers. They might discount their rates for a particular limited time, or they might offer something slightly different for a 1 year or for a 2 year versus a whole lot of other terms. So it's really important, and we're kind of keeping a bit of tabs on this every week to make sure that what we're doing is giving the best options possible for our clients. So because there are a range of differences and a range of lending options, it's really cool to get that advice from people who are doing it all the time.
Cool. I'm going to run through a bit of a case study here. So there's a few numbers on the slide for you, and this is based off someone we have done a deal for. For the most part. So we've got someone Olivia is a single borrower. So she's wanting to buy on her own. She's got an 85K salary. She's got a targeted purchase price. And as we can see there, her deposit is all coming from KiwiSaver. So she's got 25K in KiwiSaver. And therefore 25K deposit. So what she needs to borrow is 525,000. When we're looking in the background, what that uncommitted monthly income or what her income and her outgoings look like, she is in the position to borrow this. So we look at the affordability to make sure that that stacks up. One of the levers and something we have included here is a border. So each border or having a flatmate can increase your borrowing quite significantly, particularly as a single borrower. So each border can add roughly $100,000 to what you could borrow. So in this scenario, she may have only been able to borrow about $450,000, which is about right. But adding that border in has got that lending high enough where we could actually push that up a bit more and get her to the purchase price that she's looking for. So the comparison we've got here, I think, is kind of the key piece of this. So under the first home loan product, she needs to borrow $525,000. We add that 1.2% fee. So this fee can be added into your lending. So you don't have to find an extra $5,000, $6,000 in this case. It's added to your lending. So it brings that total lending to $531,300. Right now, getting access to special interest rates, the best rate we're seeing on the market for a 2-year fix is 4.99%. So we're going to use that over a 30-year loan term. That is the standard loan term at the moment in New Zealand. Obviously, we can discuss adjusting that as you move through your lending, but at the start, it's good to kind of look at it over a longer term to make sure you're comfortable with what your position looks like, especially in the first couple of years of owning a property. So we put that into our calculator, which you can also find on our website, and that's going to give you repayments of $657 per week. The comparison on that is that under a standard bank policy. So with under 20% deposit, there is a low equity margin added. This varies depending on your deposit size. So between 10 and 15% deposit, that margin is for most banks is 0.25%. If you've 0.75%. If you've got between 15 and 19% or 19.99% deposit, that margin is 0.25%. So the lower your deposit, the bigger that margin's going to be. This varies slightly between banks, but as an overall picture, this is what it generally looks like. Most of the time, the banks will require a minimum of 10% deposit in this space. So the first home loan product is really unique in that 5% is much more achievable or possible, whereas in that standard space, 10% is generally the minimum. So even if we stay with 5% deposit and just add the 0.75% right now, the interest rate with under 20% deposit is actually higher. So the best rate there is 5.19%, and then we add the margin. So with that first home loan product, like I said, we're getting the special interest rate. So it's the best market rates we're kind of seeing on the market, and it's in line with what you would get if you had 20% or more. So we then end up with a rate that's just under 6%. So we're at 5.94%, the same lending amount initially. 30-year term, and those repayments are about $721 a week. So you can see the difference there of how much better off, even on a weekly basis, you are under that first home loan product. If you had 10% deposit, so say here Olivia actually had $55,000 instead of that $25,000, and we took that out and her lending was actually $500,000, those repayments are actually still higher than under the first home loan product. So there's quite a significant difference in what that looks like for you on a weekly, fortnightly basis. And that means the banks will generally assess you can actually afford to borrow more through the first home loan scheme or product than you could through the standard under 20% options out there. There are a lot of variables and a lot of numbers, and each bank has different policies. So we have had a scenario recently where one bank approved $100,000 more than another bank. There are other factors which we'll discuss in a little bit around why this might be the case. But one of those is the levers, obviously, that border, how much we can rely on that, what the bank's test rates look like. Test rates are the interest rates the banks used to test your affordability. It's like a stress test. So right now, if we look at where those interest rates are, sort of say 4.99% being one of the best rates out there, the banks are testing closer to 7%. So it's generally around about 2% higher than where actual rates are. So we want to make sure that you could still afford your repayments, so you still afford your lending, even if or when interest rates might move a little bit in the future. That kind of leads us into a few different other ways of adjusting our lending. So I might give it to Claire to chat through some of the other levers that we've got.
Yeah, awesome. Cool. Thank you, Amber. So lots of numbers there, but we also love talking about levers. It's one of our favourite words, actually, because what it does is it opens up affordability, or it gives options. It's really important for us when you come to us to have a chat about whether or not you can afford to borrow X or Y, that we give those options and we can give you a, maybe if you did this, then it would achieve another thing, which is really important for us. So the first lever Amber's already touched on, which is having a boarder or flatmates living with you. Now, generally banks will accept up to a certain amount of boarder or flatmate income, somewhere between $200 and $250 a week. Now, it depends a lot on where you live and what might be achievable in that location, but that sort of tends to be round about the standard. Some banks will get up to about $300 a week, depending on the location. The second one there is around what we call short-term debt, which we kind of touched on earlier. And essentially that's anything that you're paying off. So Afterpay, car loans, personal loans, credit cards, Q cards, gem visas, that sort of stuff, things that you might be paying down over time. And often what happens is, to be able to borrow a bit more, repaying some of those shorter term debts, which might affect your affordability, make a huge difference. So if we go back to the person that Amber was talking about earlier, in that situation, she also had an Afterpay and we repaid that, and that increased her lending as well. So it can make quite a big difference. It just depends on how much that debt is, what your ability to pay it off is. And sometimes we have support from family or parents who are in a position to help out. That probably brings us quite nicely to that third option, which is family support. So in some situations, we'll have an individual borrower or a couple who maybe are just short of 5% or just short of 10%, depending on what they're eligible for. And often parents will be able to support them with that extra little bit. So it might be $5,000 or $10,000, or sometimes if they're in a good position and they can lift that up, that's even more helpful for you. But basically, we're always looking to get to that kind of next, that 5 or that 10. That's when things start to make a real difference in terms of that lending space. So a little bit of family support is always helpful. And often we will have conversations with you to say, hey, if you were able to get X amount more, then that would support you and to do Y. A conversation I had just yesterday with a young couple was they were wanting to buy for $650,000. They were not going to be eligible for the first home loan. So getting to that 10% deposit, $65,000, was their key thing. They had 60, so they were able to get $5,000 from family. So that's just an example of how that works really well. The last one there is buying with other people. So Amber touched on earlier that she bought her first home with her brother. I've also purchased a home with a friend. So we actually really encourage, for the right people and the right borrowers in your kind of network, it's really important to consider all of the options. So often it's a partner, of course, that's a really common one, but friends and family are also options and genuine options to purchase your first home with. We have a lot of siblings as well, but sometimes as well, parents and children will buy together. So I suppose the message here is kind of like nothing is off the table, and it's our job to have that conversation with you and figure out whether or not it's going to be possible if we take a certain action. So if we pull a certain lever, what can we achieve for you to get the result that we want?
Oh, so the next thing we go into is income. We get a lot of questions around, probably mostly around, I'm self-employed, I'm a contractor, how does this impact what I can borrow? I have a background in accounting, so I love having conversations about being self-employed. It can be really hard, or a little bit of a double-edged sword, because from an affordability or a lending perspective, you want your income to be as high as possible, but when it comes to tax, you want your income to be as low as possible. So there can be a bit of a balance, particularly as you're starting out and you have a lot of capital investment potentially into your business, what that looks like for lending. So the most common way, or the most common that comes across our desk, is if you're on a salary or you're on wages. It's really simple. You're taxed at source, you're taxed in your pay slips. When it comes into your bank account, that's what you've got to spend. So it's really simple from the bank's perspective to evidence what your income is and know what it's going to look like going forward. Bonus or commission-based income, when I just said it's a little bit about stability. It's what things are going to look like heading forward. If you've got bonus or commission income, we can absolutely rely on that, but we need a little bit more evidence or a little bit more time to prove that that is ongoing. So if you are a financial advisor like us, or maybe in real estate or something like that, where commission is quite a big piece of your income, we're kind of looking for at least 6 months knowing that it's stable. Most of the time we want to see that in place for about 12 months so that we can show that actually it is going to keep going. You're earning that consistently. The banks may also give this type of income a little bit of a haircut. So what we call that is scaling it. So scaling it so that if you aren't earning that all of the time, there is a chance that you may not earn that. We're taking that into account to make sure that you could still afford the lending, essentially. That's very similar with contracting income, or contracting and self-employed income. If you've got under 20% deposit, the banks do like to see 2 years in business, and 2 years of financial statements. Those financial statements do need to be prepared by an accountant. But if you've got 12 months and you've been doing something previously, it's always worth having a conversation around. If you've got financials, or you're working with an accountant and you've got projections, or you know what things look like, especially in a space if maybe you're a digger operator and you've been doing that, working for someone else for wages for 10 years, and you've just gone out on your own, there's absolutely levers and things we can do to try and get things across the line in that space. So it's all about kind of painting the picture of what your income has been and what it's going to look like going forward, so that we can maximize your affordability or your servicing, and have that money to go towards your repayments.
Yeah, awesome. Thanks, Amber. So, a couple of other really common questions that we get from the floor, so we might do this one together, is around second chance KiwiSaver. So, this is one that we actually starting to see a little bit more. So, the first home loan used to have some really particular price caps and requirements around borrowing in that space, which did make it less common, probably up to about 2 or 3 years ago. And the same thing happened with the second chance KiwiSaver. So a lot of those restrictions were actually removed, which means that under the second chance KiwiSaver scheme, essentially, if you've owned a property either in New Zealand or overseas before, but you didn't use your KiwiSaver to purchase that property, then you should be eligible to use it this time. So to give you an example, we had a couple about a month ago where they had actually owned property in the US, and then they have come back to New Zealand. They've then subsequently built up their KiwiSavers, and they had to go under that second chance scheme. Essentially, all it is an application to Kāinga Ora to kind of prove that you're in a similar position to a first home buyer. So that you don't have a significant amount of assets tucked away, and you also want to use your KiwiSaver for a deposit. So the majority of the time, we don't see them turning people down unless they're not eligible for whatever reason. But most of the time, that's not a problem. So second chance is I've owned a property before, but I didn't use my KiwiSaver. If you did use your KiwiSaver the first time, then it's unlikely that there would be an option to use it again. I haven't seen a situation where that would be possible. Credit ratings are also quite relevant to the overall scenario. Something I think has become a little bit of a catch cry with credit ratings is that sort of American system. In New Zealand, you don't essentially need to have heaps and heaps and heaps of sort of queries to your credit check to be able to prove serviceability. But if you do have a power account or a phone account, or you have borrowed money before and you prove that you've paid it back, that is a good thing. But you don't have to go and borrow money simply to establish a credit rating. But if you haven't paid money back at some point, so a lot of the time we'll get people coming to us saying, oh gosh, I moved overseas and I wasn't aware that something didn't get paid, then the most information you can give us, the more information you can give us, the better in that respect. And we can explain the situation and confirm for the bank that, hey, you're not a risk to lend money to, and that you will be able to manage your financial commitments heading forward. Do you want to cover pre-approvals, Amber?
Yeah, absolutely. So with pre-approvals, we've talked about them a little bit. We had a really great explanation of what they are. So they are valid for between 60 and 90 days. This varies across the banks, and it also varies depending on the deposit size that you've got. So say 60 to 90 days, and generally we can extend those at least once without needing too much more information from you. So as long as your financial position hasn't changed negatively, so if you've had a pay rise, that's awesome. But if you've taken out additional short-term debt or you've changed jobs, we would have to get some new information. But generally, they can be valid for 4 to 6 months, which is really useful or quite almost necessary, I think. And depending on the market that you're looking to buy in, it can be a long process to get into your first home and find something that works and is right for you. So we don't want you to feel like actually our approval is only valid for 2 months and we need to find something and move within that time. That is not the case. We can always look to extend or adjust those depending on your situation to make sure that you are taking your time and working through the process at a pace that works for you. We've got one more thing on here, which is what is happening with interest rates. So this is kind of jumping a little bit, and it's probably more about the market as a whole. So we have seen a lot of change or a lot of movement in interest rates, and they've been really volatile for it's been about 2 months now. Obviously, there's a few things happening in the world that will impact our economy and can have a bit of a delayed reaction to impacting us as well. But we have seen that some of the mid to longer term interest rates have already started to spike a little bit. So we've seen some increases and sort of those 2 to 5 year interest rates. We're still seeing the rates in that 6-month and 12-month space being quite competitive. However, with the outlook heading forward, the Reserve Bank meets every 7 times a year, and they kind of review the policy. Their job is to control inflation. So interest rates is one of the tools that they've got. The OCR is a tool that they've got to help control inflation. The OCR generally will impact interest rates with the bank in a nutshell, without going into too much detail. So the OCR gets reviewed. We just had an announcement last week, and that's been held as it is. That has also been held the 2 meetings we've had previously this year. At this stage, the indications are that we're going to see that increase by 0.25% in July, and we may see 3 increases by the end of this year. So what that means for interest rates is that we will likely see interest rates increasing. We don't think we're going to see rates spike to the level we saw post-COVID, where we were kind of we were in the 7% space, almost at 8% for some things. So we don't think we're going to get that high, but it is likely we're going to see a bit of a spike in interest rates. And that does mean when you are looking at buying your first home, we're having conversations around, is there anything that might impact your position in the future, or may impact your ability if those interest rates do rise? It's a conversation that is always changing. We don't have a crystal ball, and it is very unique to your situation. So if you already have lending and you want to chat it through, or if you're nervous about getting to your first home, that's really normal, particularly in this space where you don't know what's going to happen. So we're always here to kind of chat that through and make sure it's right for you as well.
Yeah, cool. I'm just going to cover just like a couple of closing comments, just reflecting on a few conversations I've had with first home buyers over the last probably couple of weeks. So here on the Waikato, I'm not sure where everybody is joining us from, but we are seeing some really good stability in our market. So I think generally there are some offers being accepted. We've got a few auctions, but a lot of negotiations. And I think the balance at the moment between affordability, which is kind of driven by interest rates, and house prices is in a bit of a sweet spot at the moment. So the reason I say that is up until probably maybe a couple of years ago or even a year ago, the rates were a little bit more expensive, which did adjust and affect that kind of overall borrowing position. But as you can see, there's lots of levers to pull. And I think now is a really quite an attractive time to actually purchase a home, because we've actually got rates that are kind of in that low to mid range. So they're not super low, don't get me wrong, but they are not at the kind of heights of where we've seen interest rates in the past. So it's a really nice space. There's not a lot of urgency out there in the market in terms of speed to make offers and lots of competition. So for first home buyers, it's actually just such a nice environment to be purchasing your first home. And I think, yeah, really, really cool to get on the ladder. Obviously, that does need to really fit for your long-term plan. But if you do have any kind of concerns about interest rates or the market or where things might be going, as Amber said, like, we're really happy to have those conversations with you individually, and answer any questions that you have. Now, we have got a little spot here just to talk about the next steps. Now, I think I just want to stress at this point how often we have these chats and people are able to do something. Now, it's actually pretty rare for us to see a scenario where there is absolutely no options out there for you. And we also can give a lot of advice around what specific things you can focus on to improve your position if that's what you want to do. So the key kind of 3 points that we cover when we ask questions of you around your position is: how much deposit do you have? What is your income and how do you earn that income? And do you have anything that you're paying off at the moment? So those are probably the 3 main ones. And that's going to give us a really good indication of where you might be sitting in terms of affordability, or will help us establish a budget for you. To reinforce, we didn't actually say this at the start, Amber, but we are free. So while that's sometimes a bit crazy for people, we are able to have a conversation. It doesn't cost you anything. So we are probably the only people in that whole home buying process who are free to you as a borrower. The two things that I just want to cover at the bottom there is getting a pre-approval is a lot easier and simpler than you think. Yes, you do have to provide a bit of information for us, but we do a lot of the hard work for you. So again, just encourage you, if you are on the fence and you're a little bit, nervous about it, we're more than happy to help and answer any questions that you have. And the last point there around moving into your first home, it is the best feeling in the world, and such a cool achievement. We get to see so many wonderful first home buyers getting into their first home like every single week, really, and it never gets old. And for anyone who is interested and has stayed with us this long, I'm also really happy to send you a free copy of my book, which I wrote a couple of years ago about buying first homes. It's got all of the info that we've talked about tonight, but it's also got a whole heap of other tips and tricks in there as well. So if you email me, here or Amber, one of us, you are most welcome to have a copy of that free of charge. And we will pop out an email after this so that you can get all these slides and all of this information for reference if you ever need to have it. Now, a couple of questions have popped up. So I might actually just ask on behalf. If you just bear with me for 1 second, I'll just read these out. So what about if I want to build my first home? Do you want to maybe talk to that one, Amber? Is that okay?
Yeah, no problem. So with building, the process is very similar. All the things that we're looking at is basically the same. So we're still going to look at your affordability and your deposit. So like Claire just said, your deposit, your income position, and anything you're paying off. So we're still looking at all of those factors. What money do you have left over after you pay your expenses? And what do you have towards the property purchase? How that lending comes about varies slightly. So when you're building, there are a couple of different pathways. So there could be, the first one would be that you purchase a block of land, and then you engage a builder to build it through a contract, kind of separately. So what you'd need to do is we'd essentially look at your position to do the first part. Most banks won't allow you to purchase land just to hold on to it forever unless you've got quite a significant deposit, and that might be as much as 50%. So for the most part, we need to show that you actually are in the position that you can afford or you can look to build in the foreseeable future. That can change, but we kind of want to show that. One of the other pathways is if you bought sort of like a house and land package. So this might be through a building company. Generally, your larger building companies offer this type of thing. It works very similarly in that you are still going to purchase the land first, and then you're going to pay for the build as that progresses. So how a build loan works is you pay on progressive payments. So as the build progresses, you're going to pay more to the builder. So what that may look like is you might pay a deposit of say 5 or 10% at the start. You might pay another 10% when the floor goes down, or when you get consent. You might pay some when the walls go up, when the wiring goes in, when the roof goes on. So as that build progresses, you pay more of the overall build cost. You're therefore borrowing more as the build progresses. So at the start, your repayments are going to be a lot lower. As you get towards the end of the build, that's when you're going to be borrowing the full amount of the money. So there are ways that we can work through that. Generally, that lending would be interest only while the build is underway, because you are likely paying rent, or you probably have some kind of living expense while you're in that build scenario. To avoid that, there's one other pathway with a new build, which is called a turnkey. We do see it a little bit. There was a lot of construction a few years ago, and we saw this a lot more. We don't see it as often at the moment, but it is definitely still out there. And this is where you pay a deposit up front, and then you basically pay the rest and get the keys once it's completed. So generally, again, through a bigger or larger building company that can generally afford to fund this type of thing, where they cover the cost of the construction, they get everything together, and then you pay at the end. Most of the time, you'll still have some input around colours or what things are in the house, but for the most part, they kind of take charge and run through that process. So those are kind of the different pathways. How the banks look at it, there can be some variances. So if you're buying land and then you're building, so you've got a contract to build, we have to allow for overruns or changes in that cost. So we might have to add, say, 5% of your build costs into that. So we want to allow that for it a little bit. So your income might not go quite as far, but it's still very, very similar. So the overall process is the same. You can still get pre-approval. We can still run through the numbers. That whole position or that whole part of it stays the same. It's just kind of what that actually looks like when you move, or the type of build that might be different. So again, have a chat if you're considering it. Because timeframes might be important for people as well. Like if you're in a position, you're like, I want to be in my first house in 2 months' time, a build is probably not the way to go. A house doesn't pop up that quickly. But if you're like, we're living with family and we'd love to be in something new and you've got 12 months, that could be a really awesome option.
Yeah, that's really cool. Thank you, Amber. I've got another question here, which I actually got earlier today as well. So that's actually really cool. Lots of people coming home from overseas, and the question is around my daughter is coming home from overseas looking to buy her first home. How long does she need to be in her role for? So this is something we didn't actually cover in that income side, but is probably a little bit relevant for new roles. Generally, if you have remained in the industry that you've been in for a reasonable amount of time, and so you're in that role as a bit of a career, and you've got a new role which has either no trial period or it has been waived, then the bank will lend you money from the time that you sign your contract and start your role. It depends a lot on the overall scenario, so that is excluded by Kāinga Ora, and if you do have a lower deposit, then that can impact it as well. But generally, if you've got certainty in the medium to long term that Amber kind of referred to before, then that's okay. So a couple who has come home from overseas are in similar roles and have got permanent contracts should be fine to borrow money reasonably quickly, but the deposit portion will affect that as well. So usually best to have a bit of a chat about the particular situation. So I'm not quite sure exactly what this situation is, but the one that I referred to earlier today, they were pretty solid in their new roles, and so we were in a position to do an approval pretty quickly. So that's a really key one that is happening quite a bit at the moment as people come home from overseas. Cool. I think that's pretty much all that we've got. Last opportunity to pop through any questions. Otherwise, you are most welcome to either flick us a message or send us an email. And we are always more than happy to help you out. But otherwise, a huge thank you to everyone for giving up what is now about 50 minutes of your Wednesday night to have a bit of a chat with us. This has been a very, very popular webinar, which means that there must be a real need out there to get some information to buy your first home. So yeah, as a kind of a final parting comment, if you really are quite keen to move forward, we would love to help. And yeah, very, very exciting. Oh, lovely comments. Thank you so much, guys, coming through. Thank you so much. So informative and great for my husband and I to know. The seminar has been great. Oh, that's wonderful. Thank you, guys. Really appreciate your time. Amber, have you got any parting comments?
I just wanted to say that, like, one last thing. I probably have, we have this conversation every day with people, and one of the biggest pieces of advice I have, or one of the things that we see the most often, is this is one of the biggest purchases, one of the biggest decisions you'll make in your life, and it's really important to our entire team that you know everything that's happening and that there are no silly questions along the way. A lot of the time you probably don't have a lot of questions when you're just starting out in the process. That's really normal. That's okay. All of your questions will generally come as you work through the process. So don't feel like, oh my God, I don't know what I'm doing, I should have all these questions. You shouldn't. You kind of don't know what you don't know, and that's what we're here for. We're here to guide you through that process, keep it as simple and as easy as possible. And if there's something we don't know the answer to, we can point you in the right direction. So it's all about creating a team of people that are really supportive. We're in your corner. We're here to help you and guide you through that process. We have been there. We have helped so many people in that position, and it is one of the most rewarding parts of our job. I think helping first home buyers is probably one of the coolest things that we do. those. So yeah, we're always here for a yarn, and whether that's getting you into things right now or having a conversation of what you need to do or what you want to do to get where you want to be. Yeah, we're always here. We've got an awesome team. We've now got 5 advisors who are always willing to have a conversation, and we have an awesome team in the background doing a bunch of work. So yeah, don't be afraid to reach out. We don't bite. And yeah.
Yay, exciting. Hey, thank you all so much for taking the time to leave a few comments. We've got a couple of others who have said, hoping to buy our first home soon. We have 4 children. Oh my gosh, amazing. That's so cool. Great. Well, thank you all so much. Thank you to Amber, my little partner in crime. She is amazing. Oh, I have a raised hand. 1 second. It may be accidental. I'm not sure. Yes, okay. I think it is accidental. That's fine. Please reach out if it wasn't accidental when you have a question. But yeah, thank you very much, guys. Have a wonderful night, and look forward to chatting to you soon.